Back with the market right here in ET now. Let's just revisit what the market is up to before we move on and discuss more numbers with other managements. We're down about almost 100 points right now, so it's not quite the listless move that we've been used to the last couple of trading sessions. 17,842 is where we're currently at for the Nifty futures, and the breadth as well, like you just saw on your screen, seems pretty much even and split. In fact, within the F&O universe, it's favoring the declines by a big margin. Almost 134 stocks are standing to the declines as we speak right now. What's under pressure? Adani Enterprises loses another 3% in trade. There's Metropolis, which is down 2.5%. HCL Technologies, which is lower by 2.5%. UBL, which is down after a very disappointing set of earnings, down 3.25%. And then there's Lupin as well, which is down 5% as we speak. On the flip side, there's BOB, PNB, PSBs clearly are the ones which are seeing some traction today. Oro Pharma, after its numbers managed to beat the street estimates, that stock is holding out. And then there is Piramal Enterprises, which is also up 2.5% as we speak. But still digesting a lot of earnings, and let's number crunch one another set. We have with us the MD at Akzo Nobel, Rajiv Rajgopal, joining in on the show right now. Rajiv, hi, morning. Great to have you on ET now as always. Strong performance, Rajiv, once again. Break it down for us. Is it largely driven by industrials or the coating segment?
Good morning. Good morning, Aisha, to you and all the viewers of ET now. Yes, we had a reasonable growth, I would say, in the quarter gone by. It looks strong when you look at the industry reported numbers so far. Our growths have obviously done better in the our industrial or coatings business, with paints reporting muted growth. It was a growth nevertheless. Yeah, I think for us, it seems that the strategy seems to be working now because we've consistently been demonstrating strong growths.
Because you're gaining market share, this is the market which is expanding.
Hi, Nikunj. Good morning. So I think we are gaining market share, Nikunj, to be precise, both on the paints and our coatings businesses. We seem to be gaining market share. And this is something that has been coming quite consistently. I've been very wary of sort of talking about it because I look at, I think it's good to talk of market share when you look at a slightly longer time frame. I think now we've seen it over the 9 months of the fiscal. So I think now it's time for us to also accept and recognize the fact that we seem to be moving the needle. We still have a long way to go through.
Also wanted to understand, Rajiv, what kind of volume growth have you witnessed this quarter? Because all your peers, be it Berger, Consign, Nerolac, they've all been clocking double-digit volume growth.
Well, as far as volume growth was concerned, I can't talk of our competitors, but my understanding is the industry was flat to negative. We've had a very low single-digit volume growth. The pricing is still sort of the carry forward of the pricing for both the industry and us is obviously still panning out, both in our coatings and in our paints business.
To the sector after entry of Grasim, because we understand that they will hit the market in 2024.
Yes, Nikunj, still too early to really talk about the formidable player in most sectors they participate. So yes, we are working on strategies. But yeah, to my mind, there are certain areas where the existing players are very strong. As far as we are concerned, we've got a very strong presence in the premium segment, our projects, etc. So we'll have to wait and watch how it pans. I'm sure everybody is putting their strategies together. There will be a bit of disruption as and when they launch. But I think every player, I'm sure, including us, is going to make sure that we work hard to protect our turf and our lunch.
Price war could happen. Every time a large player comes in, we've learned from the telecom example that a price war has happened.
Well, look, I think history has also shown that people who've come with a price war or innovation in pricing, if I were to say, going by the telecom example, because I happen to work in that industry, it's a matter of time before the existing players match. And then, that's not a differentiator. Yeah. So I don't think price alone can play. Yes, it'll create short-term disruption. As far as we are concerned, look, in Akzo Nobel, we are now playing the profitable growth story. That's what we've sort of really articulated. We've been consistent, and our endeavors to try and see how we can work around our value propositions, customer experiences so that we continue to grow profitably.
Now, I want to go back to the construct of the market. One is volume growth, second is the value growth. What are your views on both for next 2 quarters for Akzo Nobel?
Look, I think the volume growth will now start slowly picking up. It's going to drive it. But as far as this year is concerned, I think there's a carry forward close to about 6 to 7% for most players coming in on pricing. We are not going to be shy of also continuing to look at some price increases if required to manage inflation. And inflation not from a raw material, Nikunj, but also from the other costs, because wage costs, other things have also to be provided for. That said, let me tell you, the RMC is not as benign as one expected it to. You seeing it, you're also narrating it every day. The crude prices have fallen down and now are slowly going back. I think there are a lot of external circumstances which are completely beyond control. The fact is that if you look at the dollar, the dollar is still hovering around 82 rupees. One had expected it to come, the rupee to get a little stronger. That's not really panned out. Secondly, crude has come down. It's come to the mid 80s, came down to the late 70s, 78, gone back for various set of factors. Yeah, and obviously the external environment continues to be slightly volatile at this point of time. So I would wait and watch. But I do see this year the volume growths having to lead to revenue growth, to answer your question.
But just taking a leaf from that, Rajiv, because crude prices, like you said, are hugely volatile. Having said that, there has been a cool off in titanium dioxide. So I want to understand what kind of margin trajectory can we expect? And could you clock, say, that 16 to 17% range as you did pre-COVID anytime soon?
So look, we've been typically, Aisha, in the 11 to 13% EBIT margins. When you talk of EBIT margins, remember we are a number 4 player. The challenge for us is when the market leader with a 55% market share drops from 20 to 15, obviously the profitability of the industry is expected to get hurt. For me, I would like to sustain a double-digit margin, EBIT margin sort of trajectory at this point of time. But obviously, we need to also make sure that we are growing in a manner which is accretive to the business from a long term. Yeah, so that hopefully answers your question. We've put strategies in place. We are looking at new customer wins, both in our coatings business and in our paints business. I think in the paints business, one good thing that happened in the last quarter for us is the premium continued to grow. And that is a good sign. And I'm certain that if we are able to continue the trajectory with our brand launches and some new advertising that we'll put in our premium exterior very, very soon into television, I think that will help to sustain the margin trajectory.
Appreciate your time. Thank you so much for joining in and sharing with us that outlook on Akzo Nobel and how the industry dynamics as well are shaping up. Just a quick check-in on the markets right now. It's quiet for the broader markets too, and there are some select names on the Nifty 100 that are under pressure. Adani Transmission, Adani Green, Lupin, United Breweries, HCL Tech, as well as Tata Steel and Dr. Reddy's. Well, let's put the spotlight then on Rites, discuss their quarterly numbers, whether or not going forward maintaining margins is going to be a challenge, what the outlook is on their export order book. We've got Rahul Mittal, who is the Chairman Managing Director, now joining in. Thanks much for taking time out. To begin with, what's the reason for a muted revenue and PAT this year on a quarterly basis? And now what would be the top line and bottom line targets for the next year, just to understand it better?
Good morning. You see, one of our streams of revenue, that is export of rolling stock, as we have been seeing that these were compliance of the old orders, and all efforts are being made to get fresh export of rolling stock orders. And the contribution of this has been very low in the total revenue. So, year on year itself has gone down to about 1/4. In Q3, from about 360 crores to about 90 crores. But the key strength of our company is that, export of rolling stock is only one of the various streams of revenue. And our core strength is consultancy. So year on year, if you see, there's growth of consultancy revenue by 16%. And because of that, we've been able to pull back. And there has been a growth in the margins. We've been able to have a steady EBITDA margin. So I see that going forward, we will be able to deliver and we will to maintain this trend.
Also want to understand, with the rising commodity prices and falling orders in the high margin export segment, will maintaining margins going forward be a challenge? What levels do you foresee?
I don't see that as a major challenge for our margins. All our works, whether our consultancy work or our export of rolling stock or our turnkey EPC works, all our leasing revenue, we are very well taken care of by our own strengths, and I don't see any major impact on our margins. We have been maintaining a steady core EBITDA margin of about 25-26%. If you see in the 9-month to 9-month, our PAT margins are 21%, our core EBITDA margins are 28%. So I don't see that as a major challenge moving forward.
25-26% margin, then we can assume will be maintained. Now, just wanted to understand as well, you were talking about the export segment being impacted, but you've also started bidding for a new export orders in Bangladesh, Sri Lanka, Mozambique. What is the update, and will this lead to a recovery or a revival for exports? And what is the update on the export orders as well from the Vande Bharat trains?
You see, I'm sure that our efforts post-COVID of engaging with countries all over, whether it's in Southeast Asia or Africa, to get new orders, we are in advanced stages. As you correctly said, we've bid in a number of tenders. We are engaging with a number of prospective countries, even with the LOC, non-LOC segments. So I'm sure that in the coming months, we are definitely going to get some fresh orders. A start has already been made. We've got a small order for about 10 crores for 2 locomotives export to Bangladesh. So it's a small order, but it's a start. It shows that the trend of getting export of rolling stock orders has started. And I'm sure this is the only segment which, as you correctly said, was muted in contribution to our revenue. And I'm sure in the coming quarter is going to pick up.
About 5,500 odd crores. It's up 10% QOQ. What are some of the key orders in your pipeline? How do you see your order book target for the end of the year?
You see, in fact, we got in this quarter itself, we got 65 plus orders totaling to about 1,200 crores. And within a quarter, the jump was quite tremendous, about 10% in our order book growth from 30th September to 31st December. And the interesting thing is, and that's, as I say, the USP of our company, we've got orders across sectors. So like we got an order in building for IIT Delhi, we got an order for Metro Depot in Bangalore, we've got about 10 orders in highways across Northeast, we've got an order, as I said, for export of locomotives to Bangladesh, we've got an order for tunnels, so bridges in the New Farakka bridge. So across sectors, we have been getting orders, whether it's urban infra, we've got orders for metros, smart cities, city mobility plans. Across sectors, we've been getting orders, and I see this trend continuing in the coming quarters.
Outlook on your subsidiary, REMCL, it's essentially the agency to execute your renewable energy projects for the Indian Railways. How are things shaping up on that front? And if you could just walk us through how you see your consultancy and turnkey business shaping up.
You see, RMCL, there's been a tremendous growth, both because of the increased electrification in Indian Railways and the growth in traffic in Indian Railways. So RMCL primarily sources traction power for Indian Railways. There's been a year-on-year growth of plus 25% in both top and bottom lines. It's a good high margin subsidiary of ours, gives margins of about 50% plus. And as this growth continues, and also RMCL has been mandated for the net zero mission of Indian Railways. So I see very bright prospects in the growth of this subsidiary of Rites.
All right. You sound very optimistic. We hope you for the best. Thank you so much, then, for taking time out and joining in with that perspective. That's the management of Rites for you, saying that export as well, which has been under pressure, is likely to revive, and they're very confident of REMCL as well, seeing strong margin growth. 1.5% higher as we speak. But PM Modi is going to inaugurate India's 9th and 10th Vande Bharat Express. Both the inauguration will be done from the CST station, and it's going to be Mumbai's second and third train for Vande Bharat. The routes will be first from CSMT to Solapur and the other from CSMT to Shirdi. My colleague Aishwarya Patil took a tour of these trains. Let's have a look.
Well, Prime Minister Narendra Modi is all set to inaugurate two new Vande Bharat Express trains right here in Mumbai from the CST station, which is the 10th of February. These two trains are interstate trains. They'll be running from Mumbai to Solapur, and the other one is the Mumbai to Shirdi train. Currently, we are inside the Mumbai to Shirdi train. This section you can see here are these mini pantries that will be available inside Vande Bharat Express trains at regular intervals, available for refreshments for the passengers. This section here right now is the executive section, where you'll find the utmost comfort available in the Vande Bharat Express trains. They are rich in features in terms of infotainment, Wi-Fi, sensor-based doors, sensor-based reading lights, all of these features. In terms of comfort, what these trains offer is reclining seats. These seats can also turn 180 degrees. You could face the windows, enjoy the views. Also, in terms of other features are fire alarms. There's a talkback, emergency talkback that is available beside these seats. You can talk to the pilot in terms of an emergency case. There's also footrest here, and beneath every seat you'll find some charging stations.
Well, Mumbai finally, or Maharashtra finally gets its Vande Bharat trains as well. But let's also tell you, now that the Prime Minister is going to be flagging off both these trains from the Chhatrapati Shivaji Maharaj terminus today, let's tell you what the agenda is like. At 10 a.m., he's going to be inaugurating the Uttar Pradesh Investor Summit, and which is in Lucknow, and 2:45 p.m. he's going to be here in Mumbai flagging off the Vande Bharat trains. At 4:30 p.m. he's going to be inaugurating a Bori Muslim community engineering college campus, and that's also in Mumbai itself. So quite a packed day there for the Prime Minister. But in the meantime, let's get back to markets. Let's tell you what some of our fundamental experts are recommending at this hour.
I think in that space, clearly Apollo Hospital is still the leader. Still looks good. Narayana also looks good. All the elective surgeries are coming back. The occupancies are moving up. And now is the time when, and they're also expanding, all these companies, and they're also expanding into the tier 2, tier 3. And when you look at their operations, what they're doing into this tier 2, basically now they're trying to bring healthcare to where in the past they would, from people from tier 2 would travel to tier 1 for an operation. Now they're trying to reduce that inconvenience for the consumer and or rather the patient. So these stocks have also corrected. If you and given their annuity and their cash flow, it's a very predictable cash flow. People fall sick, get admitted, and therefore they can sustain a higher multiple and EV/EBITDA multiple, and current levels look good.
The merger, I think, has been in the works, but it's just getting delayed. But there's no denying the fact that the underlying fundamentals of IDFC First Bank have significantly improved. Do a quick comparison. I think it is a winner on all fronts, whether it is deposit growth rate, CASA, net interest margin, profit growth, improvement in the balance sheet quality. I think across the board, when you compare IDFC First to its peer group, it's a clear winner. The stock is at a reasonable valuation, a very aggressive management. And I think that amongst the banking stocks, it is our top pick, usual disclosure that we and our clients are invested, and should clearly outperform the Bank Nifty and some of the other larger private sector banks and maybe a few of the PSU banks as well. So that is one stock that we're very positive on.
All right, that's a view coming in on the markets, but I want to shift gears, and it's so talked about, and that's ChatGPT, because every generation has a technology that really changes the way we live and we work. And of course, the buzzword of this decade is artificial intelligence and machine learning. So unless you've been living under a rock, you obviously have heard about the chatbot sensation, and that's ChatGPT. And now Google has introduced its own AI by the name of Bard. So how do these two AI chatbots stack up against each other? We've got an explanation for you.
Every generation has a technology that changes the way that humans live and humans work. And the buzzword of this decade has to be artificial intelligence and machine learning. So unless you're sleeping under a rock, which we hope you aren't, you must have certainly heard about the chatbot sensation ChatGPT. And now, Google has introduced its own AI, which is called Bard. So how do these two AI chatbots stack up against each other? That's what we're here to explain today. First, ChatGPT. Now, you must have already had your share of fun exploring this chatbot in its initial stages. And it's possible that Google felt like it must take advantage of all the hype that has been building around the Microsoft-backed chatbot. So they launched Bard, which is in direct competition to ChatGPT. But the launch did not work in favor of Bard, as it prompted a wrong answer to a search query. And the effects of the failed chatbot reflected in the share prices of Google. The tech giant stock has taken a cut and has slid 8%. While that of Microsoft was up as much as 3%. But the big question among people who are following this space rather closely is, how are these two chatbots different? Whether it's ChatGPT or Bard, they're still in their learning phase as of now. Neither of them claim to provide a seamless experience just yet. And that's the similarity that they both share, at least at the moment. So as OpenAI builds ChatGPT in public, Google, by its own admission, has taken a more cautious route for Bard, possibly because a lot more is at stake for the giant corporation. That's because Google plans to merge Bard with its most successful, its most iconic product, which is Google Search, which really redefined the way we work in the 21st century. So chatbots may still be in a testing phase right now, but that is the advantage with artificial intelligence. It keeps learning, it keeps getting better, and one day they could be smart enough to find real-world uses that make them that much more important. And big tech's rush to capture the market at such an early stage of development is quite clearly an indication that they believe in the power of their chatbots and their underlying AI tech.